The Einstein of Wall Street. Hi friends, this is your friend Mansi. Stay tuned, this podcast will be life-changing for your trading career. Imagine this, it is the year 2030. The Indian stock market is celebrating new lifetime highs. Nifty has crossed levels nobody imagined. Every newspaper carries only positive news. Every social media influencer is talking about the next multi-bagger. Your neighbor who never discussed stocks before is now giving stock tips. Your taxi driver is discussing AI companies. Your relatives are asking, which IPO should I apply for? Your friends are saying, this time India is different. Markets cannot fall because our economy is growing. Every dip is a buying opportunity. And then, one morning, the market opens lower, then lower, then lower. Within weeks, the excitement disappears. The same people who were celebrating yesterday are now asking, should I sell everything? Is the market finished? Will the first ever recover my money? This story has happened many times before. Different countries, different decades, different reasons, but the ending is surprisingly similar. The question every investor must ask, before we talk about making money, we must answer a more important question. How do we survive? Because the stock market is not a place where only intelligent people succeed. Many intelligent people lose money. Many educated people panic. Many professionals make emotional decisions, and many ordinary investors create extraordinary wealth. The difference is not IQ, the difference is behavior. The man who survived every storm. Today we enter the world of a man who has witnessed history from the closest possible distance, a man who stood inside the heart of global finance for more than 4 decades, a man who saw the 1987 Black Monday crash, the dot-com collapse, the 2008 financial crisis, the COVID crash, multiple geopolitical shocks. His name is Peter Tuchman, known globally as the Einstein of Wall Street. For over 40 years, he stood on the floor of the New York Stock Exchange, not behind a computer, not watching from television, but right in the middle of the battlefield. Where billions of dollars changed hands every day, where fear became visible, where greed became visible, where human psychology played out every second. Chapter 1. A summer job that became a lifetime journey. Great careers sometimes begin accidentally. Peter Tuchman's journey did not start with a grand plan. After spending time in Africa working for an oil company, he returned to New York, like many young people searching for direction. He was unsure about his future. A temporary opportunity came, a summer job at the New York Stock Exchange. Just a summer job. Nothing permanent. But sometimes destiny hides inside ordinary moments. The first time Peter walked onto the trading floor, he saw something unforgettable. Thousands of people, voices everywhere, orders flying, traders negotiating. Energy, pressure, chaos. To some people it looked impossible. To him, it felt alive. He knew immediately. This is where I belong. Expert insight. The first lesson. This teaches us something important. Success rarely comes from prediction. It comes from preparation meeting opportunity. Many investors spend their entire lives searching for the perfect stock, but successful people often focus on something more fundamental. Developing skills, understanding behavior, building discipline. Because markets will always change, but the person managing the money remains the same. Chapter 2. The market is not a casino, but your behavior can make it one. Many beginners enter the stock market with one dream. How can I make quick money? They focus on hot stocks, intraday tips, options strategies, Telegram calls, social media predictions. But experienced investors ask a different question. How can I avoid permanent loss? This is the mindset difference. A casino player thinks, how much can I win today? A professional investor thinks, how do I survive for the next 30 years? The greatest investors think differently. Look at people like Warren Buffett, Charlie Munger, Rakesh Jhunjhunwala. They all understood one truth. The first rule of investing is not making money. The first rule is, do not destroy your capital. Because if you lose 50%, you don't need 50% recovery. You need 100% gain just to come back to where you started. Chapter 3. Why every crash looks different but feels the same. A crash may come because of war, inflation, banking crisis, pandemic, interest rates, Political uncertainty, technology disruption. The reason changes, but the emotion does not. Every crash follows the same human cycle. The market emotion cycle. Stage 1. Innovation. A new opportunity appears. Example: Internet, artificial intelligence, electric vehicles, renewable energy. Everyone becomes excited. Stage 2. Optimism. Early investors make money. People notice. More money enters. Stage 3. Euphoria. This is the dangerous stage. People stop asking, "Is this fairly valued?" Burra. They ask, "How much higher can it go?" Stage 4. Anxiety. Small problems appear. Investors ignore them. They say, "Temporary issue." Stage 5. Fear. Prices fall. News becomes negative. Experts become pessimistic. Stage 6. Panic. People sell not because the investment is bad, but because they cannot tolerate emotional pain. Stage 7. Recovery. The strongest companies survive. A new cycle begins. The investor who understands this cycle will not become emotionally controlled by it. Because when others panic, he sees opportunity. Chapter 4. The Day the World Learned Fear. Black Monday 1987. To understand markets, we must understand moments when markets stop behaving logically. One such moment was the 19th of October 1987, a day remembered forever as Black Monday. Imagine a world without smartphones. No instant notifications, no WhatsApp groups, no trading apps, no algorithmic trading as we know today. Only human beings, human decisions, human emotions. The New York Stock Exchange floor was filled with thousands of traders, and suddenly, selling pressure became overwhelming. Orders flooded in. People wanted to exit, but everyone cannot exit at the same time. That is the reality of markets. A market is an auction. For every seller, there must be a buyer. When fear becomes extreme, buyers disappear, and prices fall rapidly. Peter Tuchman was there. He experienced the chaos directly. He watched orders arriving continuously. He saw professional traders trying to maintain discipline while the world around them was losing confidence. Expert insight. This teaches us the first law of market survival. Liquidity disappears exactly when people need it the most. During normal times, everyone feels safe. Everyone is willing to buy. But during panic, everyone wants to sell. And suddenly, the market feels like a crowded theater where everyone is trying to reach the exit door at the same time. Indian investor connection. Think about March 2020. COVID crash, Nifty falling thousands of points. Many investors looked at their portfolios and saw 30% loss, 40% loss, sometimes more. The natural human reaction was, save whatever is left. But, experienced investors asked, are these businesses really worth 40% less? That question separates investors from emotional traders. Chapter 5. The dot-com bubble. When dreams became more expensive than reality, every generation gets its own exciting story. A story so powerful that people believe old rules no longer apply. At the end of the 1990s, that story was, the internet will change everything. And yes, it did. The internet changed humanity. But investors made one mistake. They confused a revolutionary technology with a guaranteed investment. Thousands of companies appeared. Many had no profits, no customers, no sustainable business model. But investors purchased them because they believed someone else will buy at a higher price. That is not investing. That is speculation. Indian lesson. Today we see similar patterns whenever a powerful theme emerges: renewable energy, electric vehicles, artificial intelligence, defense, railways. Every one of these sectors may genuinely transform the future. But remember, a great future industry does not automatically mean every company in that industry will create wealth. The investor's job is not to find excitement. The investor's job is to find value. Chapter 6. 2008. When the financial system trembled. The year was 2008. The world discovered that even giant institutions can make mistakes. Banks had taken enormous risks, housing markets became overheated, complex financial products hid dangerous problems. For years, everything looked fine. Then suddenly, confidence disappeared. And when confidence disappears, financial systems become fragile. Large institutions failed, markets collapsed, fear spread across the globe. India was not the center of the crisis, but Indian investors still suffered. Sensex fell dramatically. People who entered near the top experienced something painful. They had bought optimism, but they experienced reality. The greatest investor test. A bull market tests your greed. A bear market tests your character. Anyone can feel confident when prices are rising. The real test comes when your favorite stock falls 40%, your portfolio turns negative, everyone around you is afraid. At that moment, your preparation decides your outcome. Chapter 7: COVID Crash, The Unknown Enemy. March 2020. The entire world stopped, not gradually, suddenly. Airports closed. Businesses closed. People stayed inside their homes. Markets hate uncertainty, and COVID created the greatest uncertainty of our generation. Nifty collapsed rapidly. Investors were terrified. Many believed the economy will never recover. But something happened that surprised many people. Governments and central banks responded. Liquidity entered the system. Companies adapted. Digital businesses grew. Human innovation continued. Markets recovered much faster than most people expected. The biggest market lesson from COVID. The market is not a reflection of today's problems. The market is a prediction of tomorrow's possibilities. When investors saw only darkness, markets started looking toward recovery. Chapter 8: The Biggest Mistake. Thinking this time is different. Every bubble has a sentence that sounds intelligent, but is usually dangerous. This time is different. In 1929, the economy has entered a new era. In 2000, the internet has changed everything. In 2008, real estate never falls. In 2021, liquidity will always support markets. Every time, the world was different, but human emotions were identical. Here is the golden question. Whenever everyone is extremely optimistic, ask, what risk am I ignoring? Whenever everyone is extremely fearful, ask, what opportunity am I ignoring? That one question can change your investing journey. Chapter 9: Why Markets Fear Uncertainty More Than Bad News. Peter Tuchman's greatest observation from decades of experience. Markets can handle bad news, but they struggle with uncertainty. Let's understand this. Suppose a company announces, our profits declined 20%. Investors can analyze. They can calculate. They can estimate recovery. But imagine, we don't know what will happen. That creates fear. Because humans dislike uncertainty more than pain. The same applies to markets. Inflation can be measured. Interest rates can be modeled. Earnings can be analyzed. But uncertainty creates emotional decisions. Chapter 10: The Investor's Superpower. The greatest advantage in investing is not having secret information. It is having emotional control. The market gives opportunities to everyone, but only a few have the courage to act when opportunities appear. The difference between an average investor and an exceptional investor is often one thing: the ability to remain calm when others cannot, because history teaches us, every crash feels permanent while you are living through it. But every crash eventually becomes a chapter in history. Chapter 11: The Biggest Myth in the Stock Market. There is one sentence every trader has heard, and many traders have spoken. The market knows my stop loss. Someone deliberately triggered my stop loss. Operators took my shares. Big players trapped retail investors. This belief is so common that many traders stop trusting their own strategy. But today, let us understand this topic scientifically. Because sometimes, what appears to be manipulation is actually mathematics. The stop-loss mystery. Imagine this situation. Nifty is trading near 22,000. A large number of traders identify the same support level, 21,800. Thousands of traders place stop-loss orders around 21,750 to 21,800. Now imagine negative news arrives. Nifty starts falling. It reaches 21,800. What happens? Thousands of sell orders activate. More selling creates more pressure. Price falls further. Many traders see this and say, someone hunted our stop loss. But think about it. Did someone need to know individual traders' positions? Not necessarily. The market simply reacted to a large concentration of orders. Expert insight. The market is not a machine designed to punish you. It is an auction. An auction works because millions of people have different opinions. One person thinks, price is too high, I want to sell. Another thinks, this is a good opportunity, I want to buy. Price moves until both sides agree. That continuous disagreement creates the market. Chapter 12. Understanding market makers. Now comes one of the most misunderstood participants in financial markets, the market maker. Many retail investors imagine a market maker is someone controlling prices, but the reality is very different. A market maker's primary responsibility is providing liquidity, meaning helping buyers and sellers transact smoothly. A simple Indian example. Imagine a busy vegetable market. A farmer comes with 1,000 kilograms of tomatoes. But suddenly, customers disappear. Nobody wants to buy. What happens? The farmer cannot sell. The market freezes. Now imagine a trader says, I will buy these tomatoes today. I will take the risk. When buyers return, I will sell them. That person is providing liquidity. A market maker performs a similar function in financial markets. Chapter 13. Why liquidity matters. Most investors never think about liquidity during good times. They understand it only during crises. Imagine you own shares worth rupees 50 lakh. Normally, you press sell. Your order executes instantly. You receive money. It feels simple. But behind that simplicity, millions of transactions, systems, buyers, sellers, and liquidity providers are working together. Without liquidity, markets become unstable. The plane analogy. Peter Tuchman gave a beautiful analogy. Think of yourself as a passenger on an aircraft. The market maker is part of the team helping the plane function smoothly. Their job is not to decide where you travel. Their job is to help the journey happen safely. Chapter 14. Why do markets sometimes fall suddenly? Now let's address a common question. If market makers are not manipulating prices, why do stocks suddenly fall through important support levels? The answer. Because price is the result of millions of decisions, not one person's decision. Suppose a stock is trading at rupees 1,000. Everyone believes rupees 950 is strong support. But suddenly, earnings disappoint. Global markets fall. Foreign investors sell. Sentiment changes. Buyers who were waiting at 950 may cancel their orders. Now sellers dominate. Support breaks. The chart looks like someone planned it, but often, it is simply changing supply and demand. Chapter 15. Technical analysis. Why do charts work? Many investors ask, how can a moving average know where price will stop? Excellent question. The answer is not magic. It is human behavior. Millions of traders watch similar levels. They observe 20-day moving average, 50-day moving average, 200-day moving average, RSI, Fibonacci levels, previous highs and lows. Because many participants react around these levels, they become psychologically important. A simple example. Imagine a stock falls from 1,000 to 700. It reaches its 200-day moving average. Long-term investors think, great company, good price. They start buying. Short sellers think, momentum is slowing. They cover positions. Suddenly demand increases. Price rises. The moving average did not predict the future. Human decisions around that level created the reaction. Chapter 16. Technical analysis is a probability game. A professional trader does not think, this indicator is always correct. That is a beginner's mindset. Professionals think, this setup gives me an advantage over many trades. Trading is not about being right every time. Even the best traders lose. The goal is small losses, large winners. Emotional discipline. Chapter 17. The biggest difference between trader and gambler. A gambler asks, how much can I make? A trader asks, what is my risk? Before entering any trade, professionals consider, where will I exit if wrong? How much capital can I lose? Is the reward worth the risk? A person who ignores risk is not trading. They are hoping. And hope is not a strategy. Chapter 18. The professional mindset. After 4 decades on Wall Street, the greatest lesson is simple. Nobody controls the market. Not television experts. Not influencers. Not institutions. not retail investors. The market is bigger than everyone. The only thing you control is your preparation, your risk, your behavior, your decisions. Message here is, the stock market does not reward the person who predicts every move, it rewards the person who survives every move, because the biggest wealth creation opportunities usually come after the biggest fears. The question is not, can you avoid every crash? Nobody can. The real question is, when the next crash comes, will you be prepared? Chapter 19. The Indian investor has changed forever. Something remarkable has happened in India, a silent financial revolution. A generation ago, the stock market was considered a place only for experts. Many families believed, stocks are risky, share market is gambling, only professionals can make money. But today, millions of Indians are participating. Through mutual funds, SIPs, direct equity, ETFs, digital platforms, India has created a new class of investors, and this change is extremely important. Because wealth creation is not only about earning more money, it is about developing ownership. When an investor buys shares of a great company, they become a partner in that company's journey. Chapter 20. The Silent Power of SIP Investing. Let me tell you a story. A person invests 10,000 every month. Not because the market is always rising, not because every month looks positive, but because discipline matters more than prediction. During bull markets, they continue. During bear markets, they continue. During elections, they continue. During global crises, they continue. This simple habit creates something powerful: compounding. Why SIP works psychologically. Most people fail because they try to invest emotionally. They invest more when markets are high, because everyone is excited. They invest less when markets are low, because everyone is afraid. SIP reverses this behavior. It forces discipline. It removes the temptation to predict every top and bottom. Chapter 21. Price is not value. This is perhaps the most important lesson for every investor. A falling stock price does not automatically mean a bad company. A rising stock price does not automatically mean a good company. Imagine two shops. Shop A. A profitable business, strong customers, excellent management. Temporary problem. Its value remains strong, but the share price falls because investors are afraid. Shop B. A weak business, poor profits, high debt, but everyone is excited because the stock price is rising. Which one would a wise investor prefer? The first one. Because great investors buy value, not excitement. Some examples. During market corrections, quality companies often become available at better valuations. Companies like strong banks, good consumer businesses, technology leaders, manufacturing companies may temporarily fall because of market sentiment, but the business itself may remain strong. This is why investors must separate market price from business value. Chapter 22. The AI Revolution. Opportunity or bubble. Every generation has a defining technology: railways, electricity, internet, mobile phones. Now, artificial intelligence. AI is not imaginary, it is already changing industries. Productivity is increasing. Companies are adopting it. New businesses are emerging. But investors must remember one timeless lesson. A great technology does not guarantee every investment will succeed. During the internet boom, the internet was real, but many internet companies failed. The mistake was not believing in technology. The mistake was ignoring valuation. My question for investors: whenever you see a powerful trend, ask 3 questions. Question 1. Is this technology genuinely changing the world? Question 2. Is the company creating real profits? Question 3. Am I paying a reasonable price for future growth? If you cannot answer these questions, you are not investing. You are simply participating in excitement. Chapter 23. The 5 Rules of Great Investors. After studying legends across generations, one pattern becomes clear. Great investors follow simple principles. Rule 1. Protect your capital. Making money is important, but avoiding catastrophic losses is more important. A player who stays in the game gets more opportunities. Rule 2. Think long term. Markets are voting machines in the short term, but weighing machines in the long term. Eventually, business performance matters. Rule 3. Avoid emotional decisions. Fear says, sell everything. Greed says, buy anything. Wisdom says, analyze first. Rule 4. Keep learning. The market changes constantly. A successful investor from 1990 cannot blindly use the same approach today. Adaptation is survival. Rule 5. Have patience. The biggest wealth creators are often invisible for years. A tree does not grow faster because you check it every day. Chapter 24. The Crash Survival Checklist. Before the next market storm arrives, ask yourself, 1. Do I have an emergency fund? Never allow temporary market movements to affect your daily life. 2. Am I using excessive leverage? If yes, reduce it. Peace of mind is priceless. 3. Do I own quality businesses? Know what you own. 4. Can I tolerate a 30% market fall? If not, your portfolio may be too aggressive. 5. Do I have a watch list ready? Crashes create opportunities, but only for prepared investors. 6. Am I investing because of research or excitement? Be honest. Chapter 25. The Final Lesson from Wall Street. After more than 4 decades, after watching markets rise and collapse, after witnessing fear and greed, Peter Tuchman's biggest message is simple: the human element matters. Technology has transformed markets. Computers execute trades faster. Algorithms analyze data. Artificial intelligence is expanding. But one thing remains unchanged: human emotions, fear, hope, greed, courage, discipline. My final message for all investors. Dear friends, the stock market is not a place where you defeat other investors. It is a place where you defeat your own emotions. The biggest enemy is not a market crash. The biggest enemy is panic, impatience, overconfidence, and the belief that success should come quickly. Remember, every bull market creates confidence. Every bear market creates opportunity. Every crash creates stories. Some people remember crashes as disasters. Others remember them as turning points. The difference is preparation. Markets will fall. They always have. They always will. But humanity creates. Businesses innovate. Economies grow. And patient investors participate in that growth. So do not fear the next crash. Respect it. Prepare for it. Learn from history. Because the investor who survives every storm eventually enjoys every sunrise. This is Mansi, reminding you. Invest with knowledge. Trade with discipline. Build wealth with patience. And let time become your greatest financial partner.